Welcome to your complete Q&A guide for the WGU Financial Statement Analysis exam. We'll break down real exam-style questions, why the right answer works, why the others don't, and the core principle behind each one. Let's start with Domain 1, the 6-step framework, covering applying the 6-step framework to analyze statements, studying industry structure with the 5 forces model, cost leadership versus differentiation, assessing accounting quality and earnings management, evaluating profitability and risk, forecast, pro forma statements and valuation. And don't forget, our website offers free exam guides and practice questions to help you conquer your D366 exam. It's all designed to make your prep easier and more effective. Just check the link in the description below, dive in, and remember, studying smarter always beats studying harder. So let's jump right in. Question 1. A regional passenger airline and a regional water utility both describe themselves as capital intensive, yet a seasoned analyst expects steady, predictable returns from one and thin, volatile margins from the other before reading a single financial statement. Which building block of financial statement analysis best explains why the analyst holds such different baseline expectations? Your options are A. Strategy, because each firm has chosen a different way to compete. B. Financial statements, because the reported numbers already reveal the difference. C. Economics, because industry level forces shape how hard it is to earn a profit. D. Accounting quality, because one firm's numbers are more trustworthy than the others. Which one is it? Pause the video if you need more time. The correct answer is C. Economics, because industry level forces shape how hard it is to earn a profit. C is correct because economics is the building block covering industry level forces outside any single firm's control, such as regulation, competitive intensity, and barriers to entry. A regulated utility and a competitive airline live in different economic worlds, which is why their normal returns differ before strategy or reporting is even considered. A is wrong because strategy explains how a specific firm chooses to compete inside its industry, not why entire industries carry different baseline economics. The gap here exists at the industry level, not the firm level. B is wrong because the financial statements report what happened, but they do not by themselves explain why one industry sustains predictable returns and another does not. That interpretation comes from understanding the industry economics first. D is wrong because accounting quality concerns how faithfully the numbers reflect reality, not why two industries have different normal profit profiles. Nothing in the scenario points to a trust problem with either firm's reporting. Before opening a single financial statement, you need to understand industry economics, the forces outside any one company that decide how easy or hard it is to earn a profit in that line of business. These forces include regulation, the number of competitors already fighting for share, the leverage held by suppliers and customers, and how easily newcomers or substitutes can threaten the business. Together they set a ceiling and a floor on what any company in that industry can expect to earn. Consider a regional airline and a regional water utility. Both sink huge sums into fixed assets, yet the airline fights on price and rides volatile fuel cost and demand, while the utility earns steady, regulated, protected returns. Same capital intensity, opposite economics. That's why a thin profit margin looks alarming until you learn it's a grocery chain where thin margins on huge volume are simply normal, and why debt that would scare a lender is ordinary for an electric utility. The industry supplies the yardstick that gives any ratio its meaning. Two firms can post the identical return on assets, yet one sits in a fragmented market where profits get competed away, while the other holds a protected position with a moat. That's the difference between economics, the arena every firm shares, and strategy, what one player chooses to do inside it. Question 2. A furniture company's leadership decides to stop competing on price and instead build handcrafted, premium price pieces aimed at customers who value craftsmanship. This deliberate choice about how the company will compete inside its industry belongs to which building block of financial statement analysis? Your options are A. Strategy, B. Economics, C. Accounting quality, D. Financial statements. Take a second. Which answer would you pick? The correct answer is A. Strategy. A is correct because strategy is the building block covering the deliberate choices a company makes about how to compete within its industry, including whether to win on low cost or on a differentiated premium offering. Choosing craftsmanship and premium pricing is exactly that kind of firm-level competitive choice. B is wrong because economics describes the industry-level forces the firm does not control, such as rivalry and entry barriers. The decision here is a controllable choice the company made, not a feature of the industry. C is wrong because accounting quality is a judgment about how trustworthy the reported numbers are. A pricing and positioning decision is not a statement about reporting reliability. D is wrong because financial statements are the reported data itself. The scenario describes a decision that will later show up in the statements, but the decision itself is a matter of strategy. Two bakeries share the same town, the same market, and the same economic forces. One sells cheap bread by volume, the other sells premium sourdough. The industry is identical, but the choice each owner made is not, and that choice is what strategy captures. Strategy is the set of intentional decisions a company makes about how it will win. What to sell, whether to compete on price or distinctiveness, how much of production to control, how far to expand, and how many industries to enter. The keyword is intentional. Economics is inherited, strategy is chosen. Strategy leaves fingerprints in the numbers. A differentiator should show healthier margins, heavier marketing spend, and slower inventory turnover. A cost leader should show the opposite, lean overhead, thin margins, and fast turnover. When the claimed strategy and the financial fingerprints agree, the story holds together. Strategy shows up whenever the scenario describes a choice, like deciding to differentiate, acquire a supplier, or enter a new market. To tell it apart from economics, ask whether every firm in the industry shares the trait. If it does, it's economics. If it's peculiar to one company's decision, it's strategy. Skip strategy and divergent outcomes look like random noise. Study it and cause and effect emerge clearly in the numbers. Question 3. Two companies report identical revenue growth for the year. In one, customers genuinely bought more product. In the other, management pulled next quarter's sales forward to hit a target. An analyst wants the building block that captures how much of each report reflects real economic performance rather than spin. Which building block does this? Your options are A. Economics, B. Strategy, C. Financial statement, D. Accounting quality. Before I reveal it, which one do you think is right? The correct answer is D. Accounting quality. D is correct because accounting quality is the degree to which financial statements faithfully represent actual economic performance rather than reflecting bias or aggressive estimates. It is precisely the lens for telling apart two identical looking numbers that carry very different economic reality behind them. A is wrong because economics addresses the competitive forces of the industry, not whether a specific company's reported figures can be trusted. B is wrong because strategy addresses how the firm chooses to compete, which does not answer whether this quarter's reported growth is real or engineered. C is wrong because financial statements are the reported data. Both companies have a complete set of statements showing the same growth. The question is how much to trust each one, which is a separate judgment. Two companies can report identical revenue growth and still mean completely different things by it. One grew because customers bought more. The other pulled sales forward from next quarter to hit a target. Accounting quality is the concept that exists to tell those two apart. Accounting quality is the degree to which financial statements represent a company's true performance, position, and risk, rather than error or slant. Crucially, statements can follow every rule perfectly and still misrepresent the business underneath. That gap between compliance and truth is exactly why this concept needs its own name. Every later step in analysis, from judging profitability to forecasting to value in the firm, runs on reported numbers as raw material. If that material is bent, the conclusions bend too, invisibly, since the downstream arithmetic is flawless. Accounting quality is the checkpoint that asks how much of the report can be believed before any of that work begins. Picture two firms reporting identical, smoothly rising earnings. One earns that smoothness because its business is truly stable. The other manufactures it by shifting expenses between periods and leaning on convenient estimates whenever a quarter looks weak. Following the rules is only the flaw a company must clear, not proof its numbers deserve trust. A report can satisfy every requirement and still deserve deep skepticism. Knowing that difference is what separates a careful analyst from a credulous one. Question 4. An instructor stresses that one building block is simply the structured, periodic reports a company issues to outsiders, the raw material that the other blocks help interpret. A student needs to name that building block. Which one is being described? Your options are A. Accounting quality, B. Financial statement, C. Economics, D. Strategy. What's your answer? Commit to one before I continue. The correct answer is B. Financial statements. B is correct because financial statements are the structured periodic reports, including the income statement, balance sheet, statement of cash flows, and notes, that a company uses to communicate with outsiders. They are the raw data layer that the other three building blocks help interpret and validate. A is wrong because accounting quality is a judgment about that data, not the data itself. Treating the two as the same is a common trap, since a complete set of statements can still be low quality. C is wrong because economics is knowledge about the industry's competitive forces, not the company's reported figures. D is wrong because strategy is knowledge about the firm's competitive choices, not the periodic reports it files. Financial statements are the most visible building block of analysis, and precisely because they're so visible, they're also the most misunderstood. The package includes the income statement, the balance sheet, the statement of cash flows, and the statement of shareholders' equity, along with the notes that travel with them. This is simply the reported data a company issues to the outside world. A given profit margin is healthy in one industry and alarming in another. That's because the statements only supply the figures. Economics, strategy, and accounting quality supply the meaning. Picture a lender reviewing a borrower's statements. Every line fits correctly, but that completeness says nothing about whether receivables will be collected, inventory can be sold, or obligations are hidden off the page. The statements are where analysis starts, not where it ends. Everything valuable happens when other blocks act on them, not simply when we read them. Question 5. During review, a student keeps calling accounting quality a step and calling the assessment of profitability and risk a building block. An instructor corrects the mix-up. Which statement captures the correct relationship between building blocks and steps? Your options are A. The building blocks and the steps are two names for the same 6 items. B. The steps are domains of knowledge and the building blocks are the process that applies them. C. The building blocks are domains of knowledge and the 6 steps are the sequential process that applies them. D. There are 6 building blocks and 4 steps matched 1 to 1. Pick one, trust your gut. Here's your chance to test yourself. The correct answer is C. The building blocks are domains of knowledge, and the 6 steps are the sequential process that applies them. C is correct because the 4 building blocks are bodies of knowledge: economics, strategy, financial statements, and accounting quality, while the 6 steps are the ordered process that puts those blocks to work. Keeping the 2 categories distinct is a frequently tested point. A is wrong because there are 4 building blocks and 6 steps, so they cannot be the same set of items under 2 labels. B is wrong because this reverses the relationship. Knowledge sits in the building blocks and the sequential process sits in the steps. D is wrong because the counts are backward and there is no one-to-one match. There are 4 building blocks and 6 steps. A common mistake in this material is mixing up 2 kinds of vocabulary that sound similar but aren't: building blocks and steps. Let's untangle exactly what separates them. The building blocks are bodies of knowledge: economics, strategy, financial statements, and accounting quality. The steps are a sequence of 6 actions run in fixed order, from identifying industry economics all the way to valuing the firm. Knowledge sits on one side, process on the other. The cleanest way to hold this relationship is ingredients and a recipe. The building blocks are the raw ingredients the analyst brings to the table, and the steps are the ordered recipe that combines them. No one confuses the flour with the act of baking. Picture an analyst opening a fresh assignment, drawing on 4 reservoirs of understanding before any procedure begins. The 6-step process then dips into those reservoirs in turn. Economics feeds step 1, strategy feeds step 2, and accounting quality feeds step 3 and beyond. Knowledge flows into process, never the reverse. Whenever a question asks whether something is a building block or a step, just ask, does it name knowledge or does it name an action? That single test resolves the confusion every time. Question 6. An analyst is setting up a full analysis of a manufacturer and wants to run the 6-step framework in the intended sequence so that no step is attempted before its inputs are ready. Which ordering is correct? Your options are: A. Identify industry economics, identify company strategy, assess accounting quality, analyze profitability and risk, forecast financial statements, value the firm. B. Identify company strategy, identify industry economics, analyze profitability and risk, assess accounting quality, value the firm, forecast financial statements. C. Assess accounting quality, identify industry economics, identify company strategy, forecast financial statements, analyze profitability and risk, value the firm. D. Identify industry economics, assess accounting quality, identify company strategy, value the firm, forecast financial statements, analyze profitability and risk. Which would you go with? Lock it in before the reveal. The correct answer is A. Identify industry economics, identify company strategy, assess accounting quality, analyze profitability and risk, forecast financial statements, value the firm. A is correct because the framework runs industry economics first, then company strategy, then an accounting quality check, then profitability and risk analysis, then forecasting, and finally valuation. Each step supplies inputs the next one needs, so the order is not arbitrary. B is wrong because this puts strategy before industry and valuation before forecasting, both of which reverse the required dependency order. A firm cannot be valued before it has been forecast. C is wrong because accounting quality does not come first. Industry and strategy set the context before the data is even trust-checked, and forecasting cannot precede profitability analysis. D is wrong because valuation and forecasting are placed far too early and in reverse order, and strategy is separated from its correct second position. Order is not decoration in this framework. The 6 steps run in one particular sequence because each step consumes what the step before it produced, and rearranging them breaks the machinery rather than just looking untidy. The opening pair builds context, industry, economics, then strategy. The middle pair checks and diagnoses, accounting, quality, then profitability and risk. The closing pair looks forward and turns everything into a number, forecasting, then valuation. Accounting quality lands third because it's the gate between context and calculation. Once you know the industry and strategy, you must ask whether the numbers can be trusted before you ever put them to work. Running profitability analysis on unvetted figures is building on sand. Steps 4, 5, and 6 form a forward-leaning chain. Profitability and risk analysis diagnoses current performance. Forecasting projects that diagnosis into future statements. And valuation compresses the forecast into a present estimate of worth, each depending entirely on the one before it. Analysis moves from the general to the specific, from the world to the firm, from the past to the future, and from raw data to judgment. Internalize that arc, and no scrambled, plausible-sounding rearrangement will ever fool you. Question 7. While assessing accounting quality, an analyst discovers that a company's revenue recognition was far more aggressive than first believed, so real revenue growth is only about half of what was reported. The profitability analysis, forecast, and valuation were all drafted using the original figures. What is the correct next action? Your options are: A. Treat the discovery as isolated, since assessing accounting quality is a self-contained checkpoint. B. Revise the profitability analysis, the forecast, and the valuation to reflect the corrected revenue figures. C. Redo only the valuation, since that is the final number that matters. D. Leave the analysis alone, since an efficient market will already have priced in the correction. Don't overthink it. Which one feels right? The correct answer is B. Revise the profitability analysis, the forecast, and the valuation to reflect the corrected revenue figures. B is correct because the 6 steps are interrelated, so a correction in the accounting quality step flows forward into every step built on top of it. Profitability, the forecast, and the valuation all use the overstated figures and must be reworked with the corrected numbers. A is wrong because the steps are a chain, not a set of independent checkpoints. A finding in one step becomes an input to the steps that follow it. C is wrong because the valuation is not the only affected step. Profitability analysis and the forecast both consumed the flawed revenue figure and are now wrong as well. D is wrong because market efficiency does not repair an analyst's own worksheet. The internal analysis still has to be corrected regardless of how any market has priced the stock. The most exam-relevant idea in this whole framework is that the 6 steps are not independent tasks. They form a chain where each step's output becomes the next step's input. The word for this is interrelated, and it's more literal than it sounds. A revision doesn't stay politely in one step. It flows forward whether the analyst wants it to or not. Suppose the accounting review finds revenue was inflated. Profitability built on that revenue is now overstated. The forecast extended from that profitability is now too high, and the valuation resting on that forecast is now wrong. Picture the 6 steps not as separate boxes, but as links wired in series. A revision to an early finding is a change to an input that every later step already consumed, forcing each of them to be redone. Fixing only the final valuation, or trusting market efficiency to smooth things over, leaves a chain broken everywhere except its last link. The correction has to travel by hand through profitability, the forecast, and finally the value. Question 8. An analyst is building projected income statements, balance sheets, and cash flow statements for a company's next 3 years, using assumptions grounded in its industry outlook and its historical performance. Which step of the framework is this work? Your options are A. Step 3, assessing accounting quality. B. Step 4, analyzing profitability and risk. C. Step 6, valuing the firm. D. Step 5, preparing forecasted financial statements. Got a guess? Lock it in. The correct answer is D. Step 5, preparing forecasted financial statements. D is correct because preparing projected income statements, balance sheets, and cash flow statements for future periods is step 5, forecasting. It takes the findings of the earlier steps and turns them into a forward-looking set of statements. A is wrong because step 3 tests whether the historical numbers can be trusted. It does not build projections of future periods. B is wrong because step 4 diagnoses current and past performance using tools like ratios and common size analysis. Projecting future statements is a separate later step. C is wrong because step 6 converts a completed forecast into a present value. The projections themselves are produced in step 5, which comes first. Every analysis eventually stops looking backward and turns to face the future. That turning point is step 5, preparing forecasted financial statements. Forecasting means building projected income statements, balance sheets, and statements of cash flows, using assumptions anchored in everything the earlier steps established. Accounting quality judges whether the past can be trusted, and valuation converts a forecast into a present worth. Forecasting sits between them, turning understanding of the past into a quantified picture of the future. Every input the forecast needs was produced upstream. The industry outlook shows what future is plausible. Strategy shows whether the company keeps competing the same way, and the profitability trajectory shows where the firm is headed. Forecasting gathers all of it and projects it forward. A parts manufacturer forecasting a new plant doesn't hand a lender one optimistic guess. It hands over a complete, internally consistent set of future statements. That's the raw material forecasting produces. The material valuation will later compress into a single number. Question 9. An instructor describes the framework shape this way. The first 2 steps build context. One middle step is a trust check on the data before it is used for anything important. And the last steps turn everything into a forward-looking number. Which step is the trust check being described? Your options are A. Step 1, identifying industry economics. B. Step 4, analyzing profitability and risk. C. Step 3, assessing the quality of the financial statements. D. Step 6, valuing the firm. Which one is it? Pause the video if you need more time. The correct answer is C. Step 3, assessing the quality of the financial statements. C is correct because step 3, assessing accounting quality, is the deliberate pause that asks whether the reported numbers can be trusted before they are used in profitability analysis, forecasting, and valuation. It sits between the context building steps and the analytical steps for exactly that reason. O is wrong because step 1 builds context about the industry's economics. It is one of the context steps, not the data trust check. B is wrong because step 4 uses the data to diagnose performance and risk. It relies on the trust check having already happened in the prior step. D is wrong because step 6 is the final valuation, one of the forward-looking steps, not the quality check on the underlying data. A 6-step framework isn't just a list, it has a shape, and once you see that shape, no step's position is arbitrary. Let's look at why the quality check sits exactly in the middle. The opening steps build context about the industry and strategy. A single middle step checks whether the data can be trusted. The closing steps turn that trusted data into performance diagnosis, forecast, and evaluation. The trust check can't come first because judging numbers means little without industry context, and it can't come later. because every step after it treats the reported figures as raw material. Feeding it unvetted numbers poisons everything downstream. Skip that gate and ratios still come out clean and precise and still be meaningless if earnings were smoothed or assets inflated. The arithmetic can't detect a lie in its own inputs, so the analyst must catch it before diagnosis even begins. Everything before the trust check prepares the ground. Everything after it depends on its verdicts. That's why it sits precisely in the middle, not by convention but by necessity. Question 10. When the source material calls the 6 steps interrelated, it means something more specific than a suggestion to consider them together. Which statement best captures that specific meaning? Your options are: A. Each step can be performed in any order as long as all 6 are eventually completed. B. The output of an earlier step serves as an input to a later step, so an early error contaminates everything downstream. C. The steps are independent modules that never affect one another. D. Only the first and last steps are connected, while the middle steps stand alone. Take a second. Which answer would you pick? The correct answer is B. The output of an earlier step serves as an input to a later step, so an early error contaminates everything downstream. B is correct because interrelated means the steps form a chain in which each step's output feeds the next step's input. A mistake or revision early in the sequence mechanically flows forward and corrupts the steps built on top of it. A is wrong because the order is fixed precisely because later steps depend on earlier outputs. Running them in any order breaks those dependencies. C is wrong because independence is the opposite of what interrelated means. The steps are deliberately connected. D is wrong because all 6 steps connect in sequence, not just the endpoints. The middle steps both consume earlier outputs and feed later ones. In this framework, the word interrelated is doing precise mechanical work, not just describing a loose theme. It means the output of an earlier step becomes the input to a later step. So an error introduced early travels forward and contaminates everything built on top of it. 2 weaker readings get this wrong. One treats the 6 steps as independent modules that never touch. Another lets only the first and last steps connect while the middle stands alone. Both miss the structure. The steps are wired in series from beginning to end with no isolated modules and no disconnected middle. Picture the framework as a series circuit rather than parallel switches. In a series circuit, current passes through each element in turn, and a change at one point is felt at every point after it. Just like a revision to accounting quality forces the profitability analysis, forecast, and valuation to all be redrawn. The fixed sequence exists because later steps depend on earlier ones. Forecasting cannot precede the profitability diagnosis it projects, and valuation cannot precede the forecast it compresses. Rearranging the steps would ask one to run before its inputs even exist, which is simply impossible. Once you hold the strong meaning of interrelated, questions about what happens next stop being tricky. The finding simply flows forward into profitability, into the forecast, into the valuation, because that is what it means for one step's output to be another's input. Question 11. An analyst studying a coffee company maps out the full sequence of activities from growing beans to roasting, to running retail cafes in order to see which of those activities the company performs itself and which it leaves to others. Which step 1 tool is the analyst using? Your options are: A. Porter's 5 forces, B. The economic attributes framework, C. Common size analysis, D. Value chain analysis. Before I reveal it, which one do you think is right? The correct answer is D. Value chain analysis. D is correct because value chain analysis maps the full sequence of activities involved in creating, producing, and delivering a product and shows which links a given company controls directly. Tracing beans to roasting to cafes and noting who performs each link is exactly this tool. A is wrong because Porter's 5 forces measures outward competitive pressure on industry profitability, not the internal sequence of production activities. B is wrong because the economic attributes framework compares industries on demand, supply, and cost characteristics. It is not a map of one company's production steps. C is wrong because common size analysis is a step 4 tool that restates statement line items as percentages. It has nothing to do with mapping a production sequence. Trace a cup of coffee backward from the counter, and you find a long chain: growing, drying, shipping, roasting, grinding, brewing, and serving. Value chain analysis lays out that whole sequence and asks which links a company performs itself, and which it hands to outsiders. Formally, value chain analysis maps the full sequence of activities that create, produce, and deliver a product, from raw inputs through production, marketing, distribution, and after-sale support. The goal is to see where value and cost are added and how many stages a company actually controls. Porter's 5 forces looks outward at competitive pressure from rivals, entrants, substitutes, suppliers, and customers. Value chain analysis looks along the line of production instead, asking where within that sequence money is actually made and lost. A cafe-only company depends on others for beans and roasting, capturing value at the end of the chain but exposed to suppliers earlier on. A firm that grows, roasts, and sells is present at every stage, capturing more value but carrying far more capital and complexity. How many links a company controls is the essence of vertical integration, a choice examined later in the strategy step. Value chain analysis turns a vague sense of what a company does into a precise map of which stages it owns. Question 12. To compare the airline industry against the software industry, an analyst works through a common checklist covering demand growth, cyclicality, capital intensity, and how concentrated each industry is among a few large players. Which step 1 tool is this? Your options are A. The economic attributes framework, B. Value chain analysis, C. Porter's 5 forces, D. Percentage change analysis. What's your answer? Commit to one before I continue. The correct answer is A. The economic attributes framework. A is correct because the economic attributes framework is the structured checklist for comparing industries side by side on demand factors, supply factors, and cost structure, running 2 industries through demand growth, cyclicality, capital intensity. And concentration is precisely that comparison. B is wrong because a value chain analysis maps a single product's sequence of production activities, not a side-by-side comparison of 2 industries' economic characteristics. C is wrong because Porter's 5 forces frames competitive pressure from 5 directions rather than cataloging demand, supply, and cost attributes on a common checklist. D is wrong because percentage change analysis is a step 4 tool that tracks growth rates of statement items across periods, not a tool for comparing industry economics. Some analytical tools are scalpels cutting to one sharp question. The economic attributes framework is a checklist instead, and that's exactly its strength. It runs every industry through the same structured list, demand, supply, and cost examined in turn, so that no important dimension of an industry's personality gets skipped. It asks about demand growth, whether demand is cyclical, and where the product sits in its life cycle. On the supply side, it asks about concentration, capital intensity, and typical patterns of manufacturing, marketing, and financing. Put airlines and software through the framework, and the contrast is immediate. Airlines show cyclical demand, brutal capital intensity, and thin margins, while software shows product cycle-driven demand, light capital, and high margins. both measured on the identical checklist. The framework isn't about competitive pressure like Porter's 5 forces, or production sequence like value chain analysis. It's insurance against tunnel vision, ensuring demand, supply, and cost are all examined before calling an industry understood. Question 13. A new analyst reviews a grocery store chain and is alarmed that its net profit margin is only a couple of %, far below the software company she studied last week. A senior colleague tells her the margin is unremarkable here. What underlying idea explains why the same thin margin is fine for a grocer but would worry her about a software firm? Your options are: A. Thin margins always signal weak management regardless of industry. B. Grocery chains use lower quality accounting than software firms. C. What counts as a normal margin depends on the industry's economics, and thin margins are typical for high-volume grocery retail. D. Net profit margin is never a meaningful figure for any company. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is C. What counts as a normal margin depends on the industry's economics, and thin margins are typical for high-volume grocery retail. C is correct because a figure only means something once it is judged against what is normal for that industry. Grocery retail runs on thin margins and high volume, so a low margin there is routine, while the same figure in a high-margin software business would be a genuine warning. A is wrong because thin margins are not automatically a management failure. In a high-volume, low-margin industry, they are the expected operating model. B is wrong because nothing about grocery retail implies weaker accounting quality. The difference is industry economics, not reporting reliability. D is wrong because net profit margin is a meaningful figure. It simply has to be read against the industry's normal range rather than a single universal benchmark. A grocery chain reporting a 2 or 3% profit margin might sound like a disaster if you're comparing it to a software company. But that alarm is misplaced because a number only means something once you measure it against what's normal for its own industry. Grocery runs on volume, not markup, high turnover, thin per item profit by design. Software runs the opposite way, since each extra copy costs almost nothing, so wide margins are the expectation. The same margin is routine in one business and a warning sign in the other. Picture a new analyst flagging a supermarket's low margin as dangerous. A senior colleague sends the report back, not because the arithmetic was wrong, but because it was measured against the wrong comparison. Against other grocers, the margin is ordinary. Against a software firm, it looks like a crisis that isn't real. Margins, debt levels, inventory turnover, and growth rates all carry meaning only relative to industry norms. Benchmark a grocer against a software company or a utility against a manufacturer, and you'll reliably reach the wrong verdict, not because the math failed, but because the yardstick did. Whenever a scenario stresses that a company is a grocer, a utility, or a bank, and then asks if a ratio looks concerning, the real question is whether that figure is normal for that kind of business. Reach for the industry baseline before delivering any verdict. Question 14. An analyst notes that an electric utility carries a very high level of debt relative to its equity, a level that would alarm him if he saw it at a small manufacturer. For a regulated utility, how should he most reasonably read this? Your options are: A. The utility is clearly near insolvency and should be avoided. B. High leverage is normal and expected for a capital-intensive regulated utility, not an automatic solvency red flag. C. The utility must be using aggressive accounting to hide its true debt. D. The debt level proves the utility is pursuing a differentiation strategy. Which would you go with? Lock it in before the reveal. The correct answer is B. High leverage is normal and expected for a capital-intensive regulated utility, not an automatic solvency red flag. B is correct because electric utilities are extremely capital-intensive and heavily debt-financed, operating as regulated near monopolies with stable, inelastic demand. In that setting, high leverage is the ordinary operating model, so it is not automatically a sign of distress. A is wrong because a high debt ratio in isolation does not indicate insolvency for a utility whose predictable regulated cash flows comfortably support substantial debt. C is wrong because the high leverage is a normal feature of the business model, not evidence of accounting manipulation. D is wrong because utilities compete as regulated near monopolies rather than through differentiation, and a capital structure says nothing about that strategic dimension anyway. Analysts trained on manufacturers learn to fear heavy debt, and usually for good reason, but carry that same reflex into a regulated utility and the judgment misfires badly. A utility sells something people can't easily do without, so demand for power or water stays steady through booms and busts. Regulation adds a predictable return on top of that steadiness, and because building plants, wires, and pipes cost staggering sums, debt becomes the natural way to finance long-lived assets backed by reliable cash flow. Picture the two revenue lines side by side. The manufacturer's sales lurch up and down with the economy, while the utilities stay nearly flat. That flat line is what lets the utility service a large debt load without ever standing near a cliff edge. The disciplined move is to re-benchmark against other regulated utilities, not against manufacturers. Judged against the right peer group, the alarming ratio turns out to be entirely unremarkable. Heavy debt is a real warning for a cyclical competitor, but an ordinary feature of the utility model. The trait never changed, the economics around it did, which is why industry has to be understood before any single ratio is judged. Question 15. An analyst insists on studying an industry's economic characteristics before opening any single company's financial statements. Which reasoning best supports starting in that order? Your options are: our company financial statements are usually unavailable until after an industry report is published. B. Industry analysis can be skipped for well-run companies. C. The company strategy must always be identified before its industry. D. A strong management team can still post mediocre results in a brutal industry, so the numbers cannot be judged fairly until the industry's economics are understood. Don't overthink it, which one feels right. The correct answer is D. A strong management team can still post mediocre results in a brutal industry, so the numbers cannot be judged fairly until the industry's economics are understood. D is correct because industry economics set the baseline for what good and bad performance even look like. A capable team can be dragged down by a punishing industry, and a weak team can coast in a sheltered one, so the numbers only become interpretable once the industry context is established. A is wrong because availability of statements is not the reason for the ordering. The statements are typically available. The point is that they cannot be interpreted without industry context. B is wrong because industry analysis is not optional for strong companies. Even excellent firms are judged against the economics of the industry they operate in. C is wrong because the order is the reverse. Industry economics come first in step 1, and company strategy follows in step 2. Why does financial analysis always start with the industry, not the company? Because a brilliant management team can post mediocre results in a brutal industry, while a mediocre team coasts comfortably in a sheltered one. Step 1 asks what the economic rules of the game are in this industry. How intense is competition? How high are entry barriers? How much power do suppliers and customers hold? And what substitutes lurk nearby? These answers describe the terrain every firm must cross. A given return on assets is impressive in a cutthroat, low-margin industry and disappointing in a protected, high margin one. Judged without context as just a number. Judged against the industry, it becomes real evidence. Consider two companies reporting the identical modest profit margin. One fights dozens of interchangeable rivals with no barriers keeping anyone out. The other holds a protected niche with high entry barriers and little competition. Same margin, opposite stories. Skip the industry step and you'll credit the sheltered mediocre firm while doubting the excellent one trapped in a punishing market. Understand the industry first, and every figure that follows finally has a fair standard to be measured against. Question 16. In a certain manufacturing industry, one firm is the sole worldwide source of an essential raw material and can dictate price and delivery terms to every producer that needs it. Which of Porter's 5 forces is high in this situation? Your options are A. Threat of substitutes, B. Bargaining power of buyers, C. Bargaining power of suppliers, D. Threat of new entrants. Got a guess? Lock it in. The correct answer is C. Bargaining power of suppliers. C is correct because a single supplier with no competition that can set price and terms for an entire industry is the textbook picture of high supplier bargaining power. When suppliers hold that leverage, they capture more of the value created and squeeze industry profitability. A is wrong because threat of substitutes concerns customers switching to a different kind of product entirely, not an input provider dictating terms. B is wrong because bargaining power of buyers is about customers pressuring the firms, which is the opposite side of the transaction from a dominant supplier. D is wrong because threat of new entrants is about how easily new competitors can join the industry, which the scenario does not describe. Every industry has to buy inputs to make what it sells, and the bargaining power of suppliers measures how much leverage those input providers hold over price and terms. When supplier power is high, suppliers capture a bigger slice of the value created, leaving less profit for the industry itself. Supplier power runs high when a single dominant supplier controls the market, when a scarce material has no alternative, or when an input is so specialized that switching sources is painful or impossible. In the extreme, a sole worldwide source of an essential material can dictate price and delivery terms to every producer who needs it. The value created in a market is divided among everyone who touches it, and a powerful supplier simply takes more of that value through higher prices or harsher terms. Picture it as a tug of war over a fixed pool of value. When suppliers pull hard, the industry share falls and margins fall with it. Picture a manufacturing industry dependent on a single specialty compound available from just one producer worldwide. That producer can raise prices or tighten delivery schedules, and every manufacturer needing the compound must comply or halt production. So costs rise and margins erode purely from the input side. Don't confuse supplier power with buyer power. Supplier power is leverage held by those selling inputs to the industry, while buyer power is leverage held by customers purchasing its output. Both squeeze profit, but from opposite directions. So recognizing high supplier power early warns an analyst not to expect fat margins, no matter how strong demand looks. Question 17. A market long dominated by 3 established firms suddenly sees a well-funded new competitor arrive, adding capacity and pushing prices down across the board. From a step 1 perspective, which of Porter's 5 forces has just become more significant for the existing firms? Your options are A. Threat of new entrants, B. Bargaining power of suppliers, C. Threat of substitutes, D. Bargaining power of buyers. Which one is it? Pause the video if you need more time. The correct answer is A. Threat of new entrants. A is correct because a new competitor entering the industry and adding capacity is, by definition, the threat of new entrants materializing. Fresh capacity arriving to compete away profits is exactly what this force describes, and it tends to lower industry profitability. B is wrong because supplier power involves input providers gaining leverage over price and terms, which is not what a new rival entering the market represents. C is wrong because the threat of substitutes involves a different type of product, meeting the same need, not another direct competitor of the same kind entering. D is wrong because buyer power involves customers gaining leverage. Here the change is a new producer arriving, not customers gaining bargaining strength. A comfortable market can be upended not by changing customers or suppliers, but by a single new competitor walking through the door. This is the threat of new entrants, one of Porter's 5 forces, and it measures how easily outsiders can break into an industry. The engine behind this force is capacity. A new entrant adds supply, and extra supply chasing the same customers pushes prices and margins down. Whenever profits look attractive, they act as a magnet for newcomers until those excess returns get competed away. Understanding this force means understanding barriers to entry. High barriers, like enormous capital requirements, entrenched brands, regulatory licenses, or control of scarce distribution, keep newcomers out and protect incumbent returns. Strong barriers mean a weak threat, and weak barriers mean a strong one. This force is easy to confuse with rivalry among existing competitors. But the line is clean. Rivalry is firms already inside fighting each other, while the threat of new entrants is a firm outside crossing the threshold in. A price war between incumbents is rivalry. A well-funded newcomer adding capacity is entry. An industry with high returns but low barriers is living on borrowed time, since entrants will arrive to share the spoils, while high barriers let returns hold for years. Spotting this force early tells an analyst whether today's profitability is durable or about to be competed away. Question 18. A taxi company watches ride-sharing apps grow into a widely used alternative that meets the same underlying need for point-to-point transportation in a different way. From the taxi company's step 1 view, this is best described as an increase in which force? Your options are A. Threat of new entrants, B. Threat of substitutes, C. Rivalry among existing competitors, D. Bargaining power of suppliers. Take a second. Which answer would you pick? The correct answer is B. Threat of substitutes. B is correct because ride-sharing meets the same customer need through a fundamentally different kind of service, which is the defining feature of a substitute. Substitutes cap how much incumbents can charge and pull demand away, raising the threat of substitutes force. A is wrong because new entrants would be new firms starting up the same taxi business. Ride-sharing is a different type of service, so it is a substitute rather than a like-for-like entrant. C is wrong because rivalry refers to competition among firms already offering the same taxi service, not the arrival of a different service model. D is wrong because supplier power concerns input providers, which is unrelated to customers shifting toward an alternative service. The most useful thing to understand about the threat of substitutes is what separates it from a new entrant, because the two are constantly confused. A new entrant offers the same kind of product the industry already sells, like another taxi company. A substitute offers a different kind of product that meets the same underlying need, like a ride-sharing app. The need is identical, the form is different, and that difference is the whole concept. As ride-sharing grew, it did not enter the taxi business. It offered a different way to satisfy the same demand. Taxi firms found their pricing power capped because customers facing a bad fare had a genuine alternative a few taps away. This pattern repeats everywhere. Streaming video against cable television, video calls against business travel, home cooking against restaurants. Each pairs a different form against a shared need, which is substitution rather than entry. And it caps prices because customers exit the category entirely instead of just switching firms. This is why an industry can consolidate and reduce internal rivalry, yet still see its prices capped from outside. Recognizing a strong substitute early tells you the industry's pricing power is limited no matter what happens inside it. Question 19. An analyst studies a crowded local restaurant market where many similar establishments compete fiercely on price, run frequent promotions, and spend heavily on advertising just to hold their share. Which of Porter's 5 forces is most clearly high here, and what does it imply for industry profitability? Your options are: a threat of new entrants implying profitability is protected. B. Bargaining power of suppliers, implying suppliers earn most of the profit. C. Threat of substitutes, implying customers face no alternatives. D. Rivalry among existing competitors, implying margins are squeezed and profit potential is lower. Before I reveal it, which one do you think is right? The correct answer is D. Rivalry among existing competitors, implying margins are squeezed and profit potential is lower. D is correct because many similar firms fighting on price with heavy promotion and advertising is intense rivalry among existing competitors. High rivalry erodes margins through price wars and elevated marketing spend, which lowers the profit potential left in the industry. A is wrong because the scenario describes firms already in the market competing hard, not the ease of new firms entering, and high rivalry lowers rather than protects profitability. B is wrong because nothing in the scenario points to input providers holding leverage. The pressure described comes from competitors, not suppliers. C is wrong because substitutes involve a different kind of product meeting the same need, which is not what heavy price competition among similar restaurants represents. Picture a district crammed with nearly identical restaurants, each slashing prices and pouring money into ads just to hold its share. That's rivalry among existing competitors on full display, and when it runs hot, it's one of the most direct destroyers of industry profitability. Certain conditions inflame rivalry, many competitors of similar size. Slow growth that forces firms to fight over a fixed pool of customers, products that look interchangeable, and high fixed costs pressuring firms to fill capacity at any price. The crowded restaurant market carries several of these traits at once, which is why margins there stay perpetually thin. The mechanism connecting rivalry to profitability is the erosion of pricing power. When rivals are numerous and their offerings look alike, prices drift toward cost, and the added expense of marketing to stand out compresses margins from both sides. Keep rivalry distinct from the threat of new entrants. Rivalry is incumbents already in the industry battling one another, while entrants are outsiders crossing in for the first time. A vicious price war among long-established competitors is rivalry, even if the pressure feels similar to a wave of newcomers. Gauging rivalry early tells an analyst how much effort goes just to standing still against competitors, and how little profit is left once the fighting is paid for. Question 20. A parts maker sells almost all of its output to just 3 enormous retail chains, each large enough to demand price cuts, extended payment terms, and special packaging, knowing the parts maker cannot easily replace their volume. Which of Porter's 5 forces is high, and what is the effect on the parts maker's industry? Your options are: A. Bargaining power of buyers, which pulls value toward the customers and squeezes the industry's profit. B. Threat of new entrants, which guarantees higher margins for the parts maker. C. Bargaining power of suppliers, which means the parts maker dictates terms. D. Threat of substitutes, which means no customer can ever switch away. What's your answer? Commit to one before I continue. The correct answer is A, bargaining power of buyers, which pulls value toward the customers and squeezes the industry's profit. A is correct because a handful of dominant customers able to dictate price, terms, and specifications hold high buyer bargaining power. When buyers wield that leverage, they capture more of the value created and compress the selling industry's profitability. B is wrong because the scenario is about powerful customers, not the ease of new firms entering, and strong buyer power reduces rather than guarantees margins. C is wrong because supplier power would describe the parts maker dictating terms to its own customers, which is the reverse of what is happening here. D is wrong because threat of substitutes concerns customers switching to a different type of product, not large buyers using their size to extract concessions. When a handful of customers account for most of an industry's sales, they stop being mere buyers and become a force that shapes profitability. Buyer power measures how much leverage customers hold over price and terms, squeezing the seller's margins from the output side. Buyer power runs high when a few large buyers purchase most of the output, when the product is undifferentiated so buyers can switch freely, when buyers are highly price sensitive, or when they could plausibly make the product themselves. Any of these lets customers demand lower prices or better terms and walk away from worse ones. Picture a parts maker selling almost all its output to just 3 enormous retail chains. Each chain is large enough to demand price cuts, extended payment terms, and special packaging, knowing the parts maker cannot easily replace that volume. The value created in bringing a product to market gets split between seller and buyer, and a powerful buyer claims a larger share through lower prices and richer terms. Whatever the buyer captures as margin, the selling industry never keeps. If the powerful party is buying the industry's output, that's buyer power. If it's selling inputs, that's supplier power. Spotting concentrated. Powerful buyers early tells an analyst to temper profitability expectations because value is being pulled downstream to customers strong enough to take it. Question 21. A national retailer competes almost entirely by offering the lowest prices in every market it serves, running on high volume, tight overhead, and razor-thin margins per item. Which strategy is this retailer executing? Your options are A. Differentiation strategy, B. Cost leadership strategy, C. Industry diversification, D. Geographic diversification. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B, cost leadership strategy. B is correct because competing primarily by being the lowest cost provider and then underpricing rivals is the definition of a cost leadership strategy. High volume, lean overhead, and thin per item margins are the operational fingerprints of that approach. A is wrong because differentiation competes on a uniquely perceived product that supports premium pricing, which is the opposite of winning on lowest price. C is wrong because industry diversification concerns operating across multiple industries, not how a firm competes on price within one industry. D is wrong because geographic diversification concerns the spread of markets served, not the low price basis on which the retailer competes. Some companies win not by being different, but by being cheaper than everyone else, building their entire operation around that single promise. A true cost leader can undercut competitors and still make money, or match their prices and pocket a wider margin, because its cost base is genuinely lower. This is ruthless efficiency, not cutting corners. The fingerprints show up in the numbers: thin gross margins offset by high volume, lean overhead, and fast inventory turnover, since the model depends on moving product quickly rather than marking it up. Genuine cost leadership rests on real structural advantages that competitors can't easily copy: scale, process efficiency, and purchasing power, Without that foundation, being merely cheap just destroys a company's own margins. Cost leadership isn't inherently better or worse than differentiation. It depends on the industry's economics. Always confirm the financial fingerprints actually match the strategy a company claims. Question 22. A specialty audio company charges well above market price for headphones. It markets as uniquely engineered and distinctively designed, and enough customers accept the premium to keep its margins healthy. Which strategy is this company executing? Your options are A. Cost leadership strategy, B. Industry diversification, C. Differentiation strategy, D. Vertical integration. Which would you go with? Lock it in before the reveal. The correct answer is C. Differentiation strategy. C is correct because competing by offering a product customers perceive as meaningfully unique, which supports premium pricing despite higher costs to deliver, is the definition of a differentiation strategy. Charging above market on the strength of distinctiveness is exactly that. C is wrong because cost leadership competes on being the lowest cost producer and underpricing rivals, the reverse of commanding a premium on uniqueness. B is wrong because industry diversification concerns operating across several industries, not how a single product competes within its market. D is wrong because vertical integration concerns how much of the value chain a firm controls, not whether it competes on price or on a differentiated offering. A customer paying well above market price for headphones, convinced nothing else compares, is proof of differentiation at work. Instead of competing on price, a differentiator competes on being perceived as meaningfully unique enough that customers accept a premium. Formally, differentiation means offering something customers see as meaningfully different in a way that supports premium pricing despite higher costs. The uniqueness has to register with customers, and it has to translate into a price that more than covers what it costs to deliver. The strategy leaves fingerprints in the financials, healthier gross margins, since the premium outruns added cost, heavy spending on marketing, branding, research, or design, and often slow inventory turnover, since goods sell on distinctiveness rather than speed. Placed beside cost leadership, differentiation completes the pair. One wins by being cheapest, the other wins by being different enough to justify charging more, and each fits different industries and different customers. Brands fade and features get copied, so a differentiator must keep reinvesting to stay distinct. If the premium ever stops exceeding the added cost, the strategy quietly becomes a money loser dressed up as a premium brand. Question 23. An oil company drills its own crude, refines that crude in its own facilities, transports it through its own pipelines, and sells the finished fuel through its own branded gas stations. This company demonstrates a high degree of what? Your options are A. Integration, B. Geographic diversification, C. Industry diversification, D. Accounting quality. Don't overthink it, which one feels right? The correct answer is A. Integration. A is correct because controlling many successive stages of the same value chain, from drilling through refining, transport and retail, is a high degree of vertical integration. The firm participates directly in links that a less integrated competitor would leave to outside partners. B is wrong because geographic diversification is about how far operations spread across different markets, not how many stages of one production chain the firm controls. C is wrong because industry diversification is about operating in multiple distinct industries, whereas drilling, refining, and retailing fuel are all stages within the single oil value chain. D is wrong because accounting quality is a judgment about reporting reliability and has nothing to do with how much of the value chain a firm owns. How many links of an industry's value chain does a company own itself, rather than leaving to outside suppliers and distributors? That question is what degree of integration measures. A firm that just assembles finished goods from purchased components sits at the low end. One that controls raw input, production, distribution, and final sale sits at the high end. When those stages form one line of production, that's vertical integration. Picture an oil company that drills its own crude, refines it, moves it through its own pipelines, and sells fuel at its own stations. Owning every one of those links makes it highly integrated, unlike a rival that only refines and sells through independent distributors. Integration is a real trade-off. Owning more links means tighter control, but more capital and risk tied up. It also has direction, reaching backward to own suppliers, like a furniture maker buying a lumber mill, or reaching forward to own retail, like a manufacturer opening its own stores. Remember, integration means controlling more stages of one industry's chain, while diversification means operating across several unrelated industries entirely. An oil company owning drilling, refining, and retail is integrated, not diversified. Question 20. A beverage company sells the same handful of soft drink brands in more than 100 countries, but makes nothing except beverages. This company has a high degree of which dimension, and which related dimension remains low? Your options are A. High industry diversification with geographic diversification low. B. High integration with industry diversification low. C. High cost leadership with differentiation low. D. High geographic diversification with industry diversification low. Got a guess? Lock it in. The correct answer is D. High geographic diversification with industry diversification low. D is correct because selling across more than 100 countries is broad geographic diversification, a matter of market reach. Because the company still operates only in the beverage industry, its industry diversification stays low. The two dimensions are independent and are a classic point of confusion. A is wrong because this reverses the two. Selling worldwide is geographic reach, not industry breadth, and making only beverages keeps industry diversification low, not high. B is wrong because selling finished beverages in many countries speaks to market reach, not to how many stages of the value chain the firm controls. So integration is not the dimension being demonstrated. C is wrong because cost leadership and differentiation describe how the firm competes on price versus uniqueness, which the scenario does not address. Two strategy dimensions get confused more than any others: geographic diversification and industry diversification. One measures how many markets a company sells into. The other measures how many industries it operates in. A company can score high on one and low on the other. The cleanest illustration is a beverage company selling the same soft drink brands in over 100 countries, yet making nothing but beverages. Its geographic diversification is high because it operates almost everywhere. Its industry diversification is low because it lives entirely inside one industry. A purely domestic company avoids currency swings, but is fully exposed to one economy's fortunes. A multinational cushions itself against any single market's weakness, but takes on currency risk, geopolitical risk, and the strain of managing many regulatory regimes. Neither posture is safer in the abstract. The reliable check is simple. Ask whether the company is spreading across places or across industries. Selling one product in many countries is geographic breadth with industry focus, while selling many unrelated products in one country is the reverse. Mixing them up leads straight to the wrong conclusion about a company's actual risks. A global beverage maker is the standing reminder. A firm can be sprawling in its geography and utterly concentrated in its industry at the same time. Question 25. A single corporation owns an insurance business, a freight railroad, a furniture retailer, and a candy manufacturer, operating each as part of the same parent. This company has a high degree of which dimension? Your options are A. Geographic diversification, B. Industry diversification, C. Integration, D. Differentiation. Which one is it? Pause the video if you need more time. The correct answer is B. Industry diversification. B is correct because operating across several unrelated industries, insurance, rail, retail, and confectionery, under one corporate roof is the definition of high industry diversification, the conglomerate profile. Each segment lives in a different industry's economics. A is wrong because geographic diversification concerns spreading across markets or countries, which the scenario does not describe. The businesses differ by industry, not by region. C is wrong because integration concerns controlling successive stages of one value chain, but these four businesses are separate industries rather than links in a single chain. D is wrong because differentiation concerns competing on a uniquely perceived product within an industry, not the number of industries a parent company spans. Let's look at the strategy dimension that measures whether a company lives in one industry or spans many unrelated ones. At one end sits the pure play, a company like a software firm doing one thing in one industry. At the other end sits the conglomerate, spanning industries that share nothing but common ownership. Picture one parent company owning an insurance business, a freight railroad, a furniture retailer, and a candy manufacturer. Nothing connects these segments except the shared corporate ownership at the top. It's easy to confuse this with other dimensions. Integration means controlling successive stages of one industry's chain. Geographic diversification means operating across many places. And industry diversification means operating across many industries entirely. A pure play can be benchmarked cleanly against its industry, but a conglomerate's blended numbers hide more than they reveal. Spotting high industry diversification early is a signal to slow down and analyze each segment on its own terms. Question 26. A company's financial statements comply fully with every applicable accounting rule, yet an experienced analyst still rates their accounting quality as low. Which statement best explains how both can be true at once? Your options are A. Compliance with the rules is impossible, so the statements must contain errors. B. Accounting quality only measures whether a company filed its statements on time. C. The accounting rules leave room for aggressive but legal judgment and estimates, so rule following alone does not guarantee that the numbers faithfully reflect economic reality. D. Any company that follows the rules automatically has high accounting quality. Take a second. Which answer would you pick? The correct answer is C. The accounting rules leave room for aggressive but legal judgment and estimates. So rule following alone does not guarantee that the numbers faithfully reflect economic reality. C is correct because accounting rules leave wide latitude on judgment calls like depreciation pace, bad debt allowances, and revenue timing. A firm can honor every rule and still exercise that judgment aggressively, producing technically compliant numbers that do not faithfully reflect economic reality. Compliance is a flaw, not a guarantee of quality. A is wrong because compliance is entirely possible. The point is that being compliant does not by itself make the numbers high quality. B is wrong because accounting quality is about faithful representation of economic reality, not merely the timeliness of a filing. D is wrong because this is precisely the misconception being corrected. Following the rules does not automatically produce high quality accounting. A company can follow every accounting rule perfectly and still produce numbers an analyst considers low quality. That's because compliance and quality are not the same thing. and the gap between them is where careful analysis really happens. Accounting quality means the statements faithfully represent real economic performance, position, and risk. Compliance just means the statements obey the rules, because rules leave huge room for judgment on things like depreciation, doubtful account allowances, and revenue recognition. Two companies can both comply while making very different choices. Picture two firms in the same industry, both fully compliant. One makes conservative, realistic estimates, the other pushes every judgment call to the edge of what's legal. On paper, both look clean, but in substance, one firm's earnings are inflated by choices that are aggressive yet still perfectly legal. Compliance is a flaw, not a ceiling. Clearing it only proves the statements don't break the rules. It says nothing about whether the judgment behind them was sound. Never let a clean compliance record end the inquiry. The room rules leave for judgment is exactly where low-quality numbers hide, fully legal and thoroughly misleading. So real analysis looks past compliance to the choices made within it. Question 27. In an unusually volatile year, a company's allowance for uncollectible accounts turns out too low because collections were genuinely hard to predict, with no evidence that management tried to influence the figure. This gap between the reported number and reality best illustrates which concept. Your options are A. Measurement error, B. Bias, C. Earnings management, D. Industry diversification. Before I reveal it, which one do you think is right? The correct answer is A. Measurement error. A is correct because measurement error is an unintentional gap between a reported number and economic reality, caused by the inherent difficulty of estimating something like future collectability. With no intent to slant the figure, an allowance that proves too low reflects the hardness of the estimate, not manipulation. B is wrong because bias is an intentional, systematic slant introduced to serve management's interests. The scenario specifically rules out any such intent. C is wrong because earnings management involves deliberately using accounting judgment or transaction structuring to steer reported results toward a target, which again requires intent that is absent here. D is wrong because industry diversification is a strategy dimension about operating across industries and has nothing to do with estimation accuracy. Not every wrong number in a financial statement is a red flag. Some gaps between reported figures and reality happen simply because measuring a business requires estimating things that cannot be known for certain. Measurement error is an unintentional gap between a reported figure and economic reality. Things like how many receivables will be collected, how long a machine will last, or what a warranty will cost all have to be estimated in good faith. And estimates can simply turn out wrong. Measurement error and bias can produce the exact same symptom, an estimate that later proves wrong. But measurement error reflects honest difficulty, while bias reflects an intentional slant to serve management's interest. And telling them apart is what lets an analyst judge how much to trust future reports. Picture two companies that both under-reserve for bad debts. One faced an unprecedented downturn no one could have predicted. The other knew collections were deteriorating and kept the reserve low anyway to protect the quarter. Same shortfall, opposite meaning. The defining feature of measurement error is the absence of intent, a good faith estimate that reality simply outran. Recognizing that difference from deliberate bias is central to judging which company's numbers truly deserve skepticism. Question 28. A company's chief financial officer knows collections are deteriorating and that a known expense should be recorded now, but deliberately delays recording it to help the company hit this quarter's earnings target. This best illustrates which concept? Your options are A. Measurement error, B. A rounding mistake in the depreciation schedule, C. High balance sheet quality, D. Bias. What's your answer? Commit to one before I continue. The correct answer is D, bias. D is correct because bias is an intentional, systematic slant in a reported number introduced because it serves management's interests, such as hitting an earnings target. Deliberately delaying a known expense to shape the quarter is a clear example of intent-driven bias, rather than an honest estimation gap. A is wrong because measurement error is unintentional, arising from the difficulty of an estimate. Here the action is deliberate, which is the opposite of measurement error. B is wrong because a rounding mistake is an unintentional clerical slip, not a deliberate choice made to serve the company's reporting interest. C is wrong because deliberately understating a known expense degrades, rather than demonstrates, the faithfulness of the reported figures. A CFO who delays a known expense to hit an earnings target has done something very different from an honest estimate that simply missed. The number wasn't hard to get right. It was gotten wrong on purpose. That deliberate choice is the entire story. Bias is a deliberate, systematic tilt in a reported number chosen because it serves management's aims. Their motives are familiar: hitting a bonus threshold, smoothing earnings, staying inside a loan covenant, or clearing an analyst expectation. Whatever the goal, the defining trait is that the distortion was chosen. Bias and measurement error can produce the exact same visible symptom, an estimate that later proves wrong. But they mean opposite things. Measurement error is an honest miss on a hard quantity. Bias is a deliberate slant serving an interest, and the symptom alone can never tell them apart. Consider the deferred expense. The amount was known, the timing was clear, and it was delayed anyway to protect the target. That's intent laid bare. Contrast that with a warranty reserve that proved too low because a product failed in a way no one could foresee. That's honest difficulty. The whole judgment rides on one question: was the distortion chosen? An estimate wrong because the world is hard to predict is measurement error, forgivable and uninformative. An estimate wrong because someone wanted it wrong is bias, and it stains the credibility of the entire report. Question 29. A company reports smooth, steadily rising earnings quarter after quarter, but a review of the footnotes shows it has been capitalizing routine maintenance costs as assets for several years instead of expensing them. How is the situation best characterized? Your options are A. High earnings quality and high balance sheet quality with nothing to worry about. B. Earnings that look high quality on the surface paired with low balance sheet quality. C. Low earnings quality and high balance sheet quality. D. A situation that cannot be assessed without inside information. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. Earnings that look high quality on the surface paired with low balance sheet quality. B is correct because the smooth, rising earnings give an impression of high earnings quality, but capitalizing routine maintenance inflates assets and defers expenses, degrading balance sheet quality. The two dimensions can diverge, and here a distorted balance sheet sits underneath apparently healthy earning until the deferred cost eventually hit. E is wrong because there is a real problem. Assets are inflated and expenses are deferred, so the situation is not free of concern. C is wrong because the earnings appear high quality on the surface, and it is the balance sheet, not the earnings presentation, that is distorted. So this reverses the diagnosis. D is wrong because the footnote disclosure gives enough public information to identify the capitalization problem. Inside information is not required. Accounting quality isn't one score a company earns or fails. It shows up separately on two statements, and a company can look strong on one while hiding weakness on the other. Earnings quality lives on the income statement and asks whether results will persist. Balance sheet quality lives on the balance sheet and asks whether reported values are faithful. These two can point in opposite directions at the same time. Consider a company that treats routine maintenance as an asset instead of an expense. Earnings look excellent because the cost is parked on the balance sheet, and assets look higher because that parked cost inflates the asset base, but it's really just deferred expense. A distorted balance sheet eventually distorts earnings too. When those capitalized costs finally get written down, they strike future earnings, and the apparently high earnings quality collapses right as the balance sheet's weakness surfaces. High quality accounting requires both persistent earnings and faithful balance sheet values, because weakness in one migrates into the other over time. Always ask the two questions separately rather than collapsing them into a single verdict. Question 30. An instructor explains that step 3 cannot be reduced to a mechanical checklist because management's judgment permeates the financial statements, the notes, and the discussion and analysis. That same influence over estimates and disclosures creates the possibility of what? Your options are A. Measurement error that no one could ever detect. B. Geographic diversification. C. Earnings management, the use of accounting judgment or transaction structuring to steer reported results toward a target. D. Strong form market efficiency. Which would you go with? Lock it in before the reveal. The correct answer is C. Earnings management, the use of accounting judgment or transaction structuring to steer reported results toward a target. C is correct because management controls the estimates and disclosure choices behind the statements. It also has the means to steer results toward a target through accounting judgment or how transactions are structured. That deliberate steering is earnings management, which is exactly why step 3 demands active skepticism rather than a checklist. A is wrong, because measurement error is unintentional and not the capability created by management's discretion. The concern raised here is deliberate influence, not undetectable honest error. B is wrong because geographic diversification is a strategy dimension unrelated to management's influence over reported results. D is wrong because strong form efficiency is a capital markets concept about prices reflecting all information, not a consequence of management's discretion over its own reporting. The people who run a company are the same people who prepare its financial statements. That single fact means judgment permeates every number, note, and disclosure, and it's exactly what makes earnings management possible. A checklist can confirm required items are present, but it can't judge whether the discretion behind them was honest. Valuing assets, timing revenue, and shaping disclosures all run through management's hands, demanding active skepticism instead of blind trust. Earnings management works through two broad routes: adjusting accounting judgment, like stretching an asset's useful life, or structuring real transactions, like timing a sale to flatter the picture. Both exploit the same discretion that makes management central without ever clearly breaking a rule. The very discretion that lets a conscientious manager report faithfully is the discretion a self-interested one can use to steer earnings toward a target. An analyst can't tell these apart by assuming good faith alone. Because management's influence over the numbers is unavoidable, every later step in analysis depends on figures that may have been steered. Assessing quality means confronting that possibility directly, something only informed skepticism can do. Question 31. An analyst wants to compare what share of total assets is tied up in inventory at a small regional retailer versus a much larger national chain, stripping away the raw difference in their size. Which Step 4 tool is designed for this? Your options are A. Percentage change financial statement, B. Common size financial statements, C. Value chain analysis, D. Asset-based valuation. Don't overthink it. Which one feels right? The correct answer is B. Common size financial statements. B is correct because common size statements restate each line item as a percentage of a common base, total assets for the balance sheet, which removes the effect of raw size and lets a small firm be compared cleanly against a much larger one. Expressing inventory as a percentage of total assets is exactly this tool. A is wrong because percentage change statements track how each line item grows from one period to the next, which measures momentum over time rather than structure within a period. C is wrong because value chain analysis maps production activities in step 1 and does not restate financial statement items as percentages. D is wrong because asset-based valuation is a step 6 method for estimating firm value, not a tool for comparing balance sheet structure across two companies. Raw dollar figures make it almost impossible to compare a corner store to a national chain because sheer scale drowns out everything else. Common size statements solve this by stripping away absolute size and revealing the structure underneath. On the balance sheet, every item becomes a percentage of total assets. On the income statement, every item becomes a percentage of total revenue. So inventory and cost of goods sold turn into comparable shares instead of raw dollars. Once both companies are expressed on the same 0 to 100 scale, their structures sit side by side on equal footing, regardless of how different their absolute sizes are. Common size analysis is a snapshot of structure in a single period. It does not track change over time, and it does not relate two different accounts to each other in a ratio. Reach for common size analysis whenever the task is comparing proportional makeup across differently sized companies, because it's the one tool built to make structure legible once scale is stripped away. Question 32. Reviewing one company across 2 years. An analyst notices that accounts receivable grew 40% while revenue grew only 5% over the same period. Which Step 4 tool most directly surfaces a mismatch like this? Your options are A. Common size financial statements, B. Financial statement ratios, C. Porter's 5 forces, D. Percentage change financial statements. Got a guess? Lock it in. The correct answer is D. Percentage change financial statements. D is correct because percentage change statements express each line item's growth from one period to the next, which is exactly how a gap between receivables growing 40% and revenue growing 5% comes into view. The tool is built to reveal momentum and items moving out of step with one another. A is wrong because common size statements show structure within a single period as a percentage of a base, not growth rates across periods. So divergence in growth would not stand out the same way. B is wrong because a ratio relates two accounts at a point in time. While a receivables ratio could hint at the issue, the direct surfacing of differing growth rates is the percentage change tool's job. C is wrong because Porter's 5 forces is a step 1 industry tool and does not examine a company's period over period line item growth. When inventory climbs far faster than sales, something is usually wrong, and that kind of problem shows up in growth rates long before it hits the margins. Percentage change analysis is the tool built to catch it. A percentage change statement restates each line as its rate of change from one period to the next. Where common size analysis freezes a single period to show structure, percentage change analysis spans periods to show momentum. The tool is designed to expose mismatches in growth rate, revenue growing, while receivables grow much faster, inventory outpacing sales, or expenses rising quicker than the revenue meant to cover them. Suppose accounts receivable grow at a rate many times that of revenue. Laying the two rates side by side makes the gap leap out, an early warning that something is deteriorating before it ever reaches the income statement. Common size shows how a company is built. Ratios show how accounts relate. And percentage change shows how the business is moving. That momentum view often catches trouble first before it ever distorts structure or ratios. Question 33. An analyst divides a company's net income by its average total assets to gauge how efficiently the business turns its asset base into earnings. This calculation is an example of which Step 4 tool. Your options are A. A financial statement ratio, B. A common size financial statement, C. A percentage change financial statement, D. A value chain map. Which one is it? Pause the video if you need more time. The correct answer is A. A financial statement ratio. A is correct because a financial statement ratio expresses the relationship between two different line items, often drawn from different statements. Net income divided by average total assets relates an income statement figure to a balance sheet figure, which is the definition of a ratio. B is wrong because a common size statement restates a single item as a percentage of one common base within a statement, not a relationship between two distinct accounts across statements. C is wrong because a percentage change statement expresses one item's growth across periods, not a relationship between two different accounts in the same period. D is wrong because a value chain map is a step 1 tool tracing production activities, not a numeric relationship between financial statement items. A financial ratio expresses the relationship between two different line items, often from two different statements in a single number. It's not a share of a total and not a growth rate over time. It's one account measured against another, revealing something neither figure shows alone. The standard illustration is dividing net income by average total assets. Net income comes from the income statement, total assets from the balance sheet, and linking them reveals how efficiently the company converts its asset base into earnings. That cross-statement linkage is the essence of a ratio. Ratios exist because raw statements still leave relational questions unanswered. How much profit each dollar of assets generates? How comfortably bills get covered? How heavily the company relies on debt? Ratios are a family, not a single measure, tuned to profitability, efficiency, liquidity, and solvency, along with broader risk. What sets a ratio apart is that two-account relationship. A common size figure relates one item to a base within a statement, and a percentage change figure relates one item to its own prior value. A ratio reaches across statements to relate two genuinely different accounts, and that reaching across is its signature move. A lender can't judge profitability from total assets alone or investment from net income alone, but their ratio shows how productively the company uses what it has. That's why ratios anchor step 4. They capture relational judgments about performance and risk that no other tool can. Question 34. A company earns strong returns but funds itself with heavy debt that magnifies both its gains and its potential losses. Using the two halves of step 4, how is this company best described? Your options are A. Low profitability paired with low risk, B. High profitability paired with low risk, C. High profitability paired with potentially high risk, D. A company that cannot be analyzed until it reduces its debt. Take a second. Which answer would you pick? The correct answer is C. High profitability paired with potentially high risk. C is correct because step 4 evaluates profitability and risk as two separate dimensions that can point in different directions. Strong returns indicate high profitability, while heavy leverage that amplifies gains and losses indicates elevated risk. So the fair description is profitable but potentially risky. A is wrong because the company earns strong returns. So describing it as low profitability contradicts the scenario. B is wrong Because heavy leverage that magnifies losses is not low risk. The debt load raises the risk side even as profitability stays high. D is wrong because heavy debt does not make a company unanalyzable. Step 4 is designed precisely to capture both the profitability and the risk of a leveraged firm. A company can be profitable and dangerously risky at the same time. That's why Step 4 splits into two separate halves rather than one verdict: profitability analysis and risk analysis. Profitability asks how efficiently a company turns revenue, assets, and equity into earnings. Risk asks whether it can meet its obligations covering liquidity, solvency, credit, bankruptcy, and market risk. Leverage shows why both matter. It can boost profitability while quietly loading on risk. Crossing the two dimensions produces four pictures: profitable and safe, profitable but risky like a highly leveraged firm, modestly profitable but very safe like a low-debt utility, or struggling and risky at once. Step 4 exists to place a company correctly into one of these. Take a firm earning strong returns on heavy debt. Through the profitability lens, it looks like a standout, but through the risk lens, that same leverage could deepen losses and threaten its obligations in a downturn. Step 4 exists to build a complete diagnostic picture, not to crown a single number, because lending, investing, and extending terms all depend on knowing how a company performs and how likely it is to survive. Question 35. An instructor stresses that Step 4 relies on 3 tools together because each answers a different question that the others would miss. Which pairing of tool to question is correct? Your options are: A. Common size shows structure within a period. Percentage change shows momentum across periods, and ratios show relationships between accounts. B. Common size shows momentum, percentage change shows relationships, and ratios show structure. C. All 3 tools answer the same question in slightly different formats. D. Ratios show structure within a period, common size shows growth, and percentage change shows relationships. Before I reveal it, which one do you think is right? The correct answer is A. Common size shows structure within a period, percentage change shows momentum across periods, and ratios show relationships between accounts. A is correct because the 3 tools are complementary lenses. Common size reveals structure within a single period, percentage change reveals momentum from one period to the next, and ratios reveal the relationship between 2 accounts. Using all 3 catches what anyone alone would miss. B is wrong because this scrambles the assignments. Common size is structure, not momentum, and percentage change is momentum, not relationships. C is wrong because the whole point is that the 3 tools answer genuinely different questions, not the same question in different formats. D is wrong because this also mismatches the tools. Ratios show relationships, common size shows structure, and percentage change shows growth. None is stated here. No single tool can show everything about a set of financial statements. That's why the 4th step combines 3 of them together, each catching something the others would miss. Common size analysis speaks to structure within a single period. Percentage change analysis speaks to momentum across periods. And financial statement ratios speak to relationships between accounts. A cost category might look normal in structure yet be accelerating dangerously, something only percentage change reveals. A ratio might look healthy while the underlying growth rates diverge beneath it. Relying on just one tool is choosing to be partly blind on purpose. The reliable mapping is fixed. Common size maps to structure, percentage change maps to momentum, and ratios map to relationships between accounts. Swapping those assignments means the wires have crossed. Step 4's power comes from triangulation. 3 tools trained on the same data, each compensating for the other's blind spots. That is the only way to build the full diagnostic picture the step is meant to produce. Question 36. 2 draft forecasts land on a manager's desk. One projects 25% annual growth indefinitely because leadership hopes to reach that level. The other projects growth in line with the industry outlook and the company's recent validated performance. Which better reflects the core principle of sound forecasting and why? Your options are A, the first, because ambitious targets motivate stronger results. B, neither, because forecasts should cover only the income statement. C, the first, because a forecast should reflect what management wants to happen. D, the second, because a forecast should represent the likely future outcome rather than a hoped-for one. What's your answer? Commit to one before I continue. The correct answer is D. The second, because a forecast should represent the likely future outcome rather than a hoped-for one. D is correct because a sound forecast represents the realistic likely future, grounded in the industry outlook and validated against the company's own history and peers. The second draft does this, while indefinite growth chosen because leadership hopes for it is optimism substituting for method. A is wrong because a forecast is an estimate of the likely outcome, not a motivational target. Ambition does not make a projection accurate. B is wrong because a good forecast is comprehensive across all three statements, so limiting it to the income statement is itself a flaw, and this option ignores the realism principle being tested. C is wrong because what management wants to happen is precisely what a forecast should not be built on. Realistic expectations, not preferences, are the standard. Put two forecasts side by side and the difference between a sound one and a hopeful one becomes obvious. One reflects a steep growth rate leadership would love to hit. The other reflects the industry outlook and the company's own validated performance. A forecast is meant to represent the likely future, not the desired one. Optimism, however sincere, is not a forecasting method. It's a bias dressed up as a projection, and building on it predicts nothing. This principle sits at the foundation because everything downstream inherits the forecast's assumptions. A valuation built on an inflated growth rate is inflated in turn, and a lending or investment decision resting on that number rests on sand. The discipline that keeps a forecast realistic is grounding and validation. A defensible growth assumption ties back to the industry's actual outlook, the company's demonstrated recent performance, and how comparable firms have really behaved. A forecast is a prediction, not a promise or a goal. Judge it by whether it's likely to come true, not by how appealing it looks. Holding that line is the first thing a sound forecast requires. Question 37. A lender asks for a forecast that covers operating, investing, and financing activities together, produces a balance sheet that actually balances, and rests on assumptions checked against the company's history and its peers. These requirements describe which qualities of a good forecast. Your options are A. Optimistic, promotional, and single statement. B. Comprehensive, internally consistent, and validated. C. Backward-looking, isolated, and unaudited. D. Cyclical, seasonal, and tax-adjusted. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. Comprehensive, internally consistent, and validated. B is correct because a sound forecast is comprehensive in covering operating, investing, and financing activities across all three statements. Internally consistent, so the statements tie together and the balance sheet balances, and validated by checking assumptions against history and industry peers. The lender's requirements name exactly these qualities. A is wrong because optimistic and promotional contradict the realism standard, and a single statement projection fails the comprehensiveness requirement. C is wrong because good forecasts look forward, integrate the statements, and rest on validated assumptions, the opposite of backward-looking and isolated. D is wrong because cyclicality, seasonality, and tax treatment may feature in a forecast, but they are not the three general qualities the requirements describe. Realism gets a forecast started, but it isn't enough on its own. A projection can have perfectly realistic growth assumptions and still be useless if it's incomplete, contradicts itself, or rests on assumptions nobody ever checked. A sound forecast must satisfy three further demands beyond realism. It must be comprehensive, internally consistent, and validated. Together with realism, these four qualities separate a usable forecast from a mere sketch. Comprehensive means covering the whole business, operating, investing, and financing activities, producing a full income statement, balance sheet, and cash flow statement. Internally consistent means those statements tie together. The balance sheet balances, cash flows reconcile, and net income flows into retained earnings. Validated means the assumptions have been checked against evidence rather than accepted on faith, comparing growth rates, margins, and turnover ratios to the company's own history and to comparable firms. An assumption that looks reasonable alone can fail once measured against real performance. A forecast is a system of interlocking statements resting on defensible assumptions. Realism makes assumptions likely. Comprehensiveness leaves nothing out. Consistency makes the pieces fit. And validation lets the whole thing survive contact with evidence. Together, what a lender can actually rely on. Question 38. An analyst follows the 7-step forecasting game plan and wants to start with the item that nearly everything else in the projection scales from. Which item is projected first? Your options are A. Financial leverage and capital structure. B. The statement of cash flows. C. Revenue. D. Interest expense. Which would you go with? Lock it in before the reveal. The correct answer is C. Revenue. C is correct because revenue is projected first because operating expenses, working capital, and most other lines scale off it, and its growth rate is grounded in the industry outlook and the company's strategy. Building from the top of the income statement downward is the whole logic of the game plan. A is wrong because capital structure is projected later, after revenue, expenses, and working capital establish how much financing the firm will actually need. B is wrong because the statement of cash flows is derived near the end, once the income statement and balance sheet are built, not at the start. D is wrong because interest expense follows from the projected debt balances, so it cannot be estimated until after revenue and the capital structure are in place. A financial forecast has many moving parts, and guessing the bottom line directly never hangs together. The 7-step game plan instead builds a projection in the order the numbers actually depend on each other, starting with revenue. Revenue leads because so much else is driven by it. Operating expenses tend to move with sales. Working capital items like receivables and inventory scale off revenue through turnover relationships. And even financing needs depend on how much the business is expected to grow. Revenue itself isn't a guess pulled from thin air. It rests on the industry outlook and company strategy established earlier, and from there the forecast proceeds in strict dependency order: expenses, then working capital, then financing, then debt and interest expense, ending in the balance sheet, cash flow statement, and validation. The mental model to avoid is starting downstream. You can't project interest expense before the debt exists, or size working capital before revenue is set. Each figure must follow the item it depends on as an input. The game plan matters because it treats a forecast as a chain of dependencies, not a list of independent guesses. Start with the figure everything else relies on, and the whole projection ties together. Question 39. A student assumes forecasting means guessing next year's net income directly and working backward from it. Why is this the wrong mental model for the 7-step game plan? Your options are: A. Net income is an output of the process, arrived at by projecting revenue, then expenses, then the rest, rather than an assumption chosen at the start. B. Net income is never included in a forecast at all. C. The game plan begins with the statement of cash flows and ignores the income statement. D. Forecasts are required to start from the balance sheet's ending cash figure. Don't overthink it. Which one feels right? The correct answer is A. Net income is an output of the process, arrived at by projecting revenue, then expenses, then the rest, rather than an assumption chosen at the start. A is correct because the game plan works from the top of the income statement downward, projecting revenue first, then operating expenses, then working capital and financing, so net income falls out as a result of those projections. It is an output of the sequence, never the starting assumption. B is wrong because net income certainly appears in a forecast. The point is that it is derived rather than assumed at the outset. C is wrong because the process builds the income statement first and derives the cash flow statement near the end. So it does not begin with cash flows or ignore the income statement. D is wrong because forecasts begin by projecting revenue, not by starting from an ending cash balance on the balance sheet. A common mistake treats forecasting as guessing next year's profit and then working backward to justify it. That picture is intuitive and completely wrong. The 7-step game plan works from the top of the income statement downward. Revenue is projected first, then expenses, then working capital and financing, with net income sitting at the very bottom, determined by everything projected above it. Net income is a result, computed from the assumptions that drive the projection, never a number the analyst picks first and reverse engineers the statements to reach. Starting from the bottom line corrupts the entire projection. Assumptions stop being honest estimates and become whatever values produce the desired profit, which is exactly how a forecast loses its grounding. A derived net income can be validated, an assumed one can only be rationalized. Project revenue, expenses, and financing in order, then accept whatever net income results, even if it disappoints. Question 40. An analyst notes that Step 5's forecast is built mostly by extending historical margins, growth rates, and turnover ratios forward. Why does this make the forecast depend directly on the accounting quality work done in Step 3? Your options are: A. Because forecasts never rely on historical data of any kind. B. Because accounting quality only affects the balance sheet, which forecasts ignore. C. Because Step 3 is actually performed after Step 5 in practice. D. Because a forecast extrapolates historical relationships, so any distortion in those historical numbers is inherited by the projection. Got a guess? Lock it in. The correct answer is D. Because a forecast extrapolates historical relationships, so any distortion in those historical numbers is inherited by the projection. D is correct because forecasting extends historical financial statement relationships forward, which means the projection is only as trustworthy as the historical figures it extrapolates from. If Step 3 found those figures distorted, the forecast inherits the distortion, making accounting quality the raw material of a good forecast. A is wrong because forecasts rely heavily on historical data. That reliance is exactly why accounting quality matters so much here. B is wrong because accounting quality affects both earnings and the balance sheet, and forecasts use both, so this understates the link. C is wrong because Step 3 precedes Step 5 in the framework, and the forecast depends on the quality findings established before it. A forecast is only as trustworthy as the historical numbers it extends. That's the mechanical link between checking accounting quality and building a projection. To project expenses, an analyst uses historical margins. To project working capital, historical turnover between revenue, receivables, inventory, and payables. To project growth, the company's demonstrated trajectory. Every input comes straight from the reported statements. Suppose historical earnings included a one-time gain that will not recur. Forecasting from that unadjusted figure projects the gain forward every year, overstating earnings and any valuation built on them. If reported earnings were inflated or obligations understated, extending those figures forward carries the floor straight into the future, reproducing the distortion as though it were real. The reliability of any projection is capped by the quality of the historical data it's built from. High-quality history supports a forecast worth believing. Low-quality history guarantees one that misleads. Question 41. An analyst preparing to value a company recalls that analysts usually triangulate across three broad families of valuation, rather than relying on just one. Which set correctly names the three families? Your options are A. Weak form, semi-strong form, and strong form valuation. B. Cash flow based, earnings based, and asset based valuation. C. Common size, percentage change, and ratio valuation. D. Rivalry based, entry based, and substitute based valuation. Which one is it? Pause the video if you need more time. The correct answer is B. Cash flow based, earnings based, and asset based valuation. B is correct because the three valuation families are cash flow based, which discounts projected free cash flows, earnings based, which applies a multiple to earnings, and asset based, which values the firm from the fair value of its assets. Analysts triangulate across them because each suits different circumstances. A is wrong because weak, semi-strong, and strong are forms of market efficiency, not families of valuation. C is wrong because common size, percentage change, and ratio analysis are the three-step 4 diagnostic tools, not valuation families. D is wrong because rivalry, entry, and substitutes are among Porter's competitive forces, which belong to step 1 rather than to valuation. Valuation is the payoff of the whole framework, turning a forecast into an estimate of what a company is actually worth. Seasoned analysts rarely trust one method alone. They triangulate across three families of approach and see where the estimates agree or disagree. The three families are cash flow-based valuation, earnings-based valuation, and asset-based valuation. Each rests on a different logic suited to a different kind of business. Cash flow-based valuation discounts projected free cash flows, fitting predictable cash generators. Earnings-based valuation applies a multiple, like price to earnings drawn from credible peers. Asset-based valuation sums the fair value of assets net of liabilities, fitting tangible, asset-heavy businesses. Where the three estimates converge, confidence in the valuation rises. Where they diverge, that gap itself is informative, pointing to which assumptions deserve a second look. Valuation is a matter of judgment supported by triangulation, not a single formula mechanically applied. An analyst who knows which family fits which business and cross-checks one estimate against another produces a far more defensible view of value. Question 42. A 12-partner consulting firm with almost no fixed assets, no debt, and a loyal base of repeat clients is being sold. Which valuation approach generally fits this kind of asset-light service business best? Your options are A. A price-to-sales or earnings-based approach. B. A pure asset-based approach built on the fair value of its physical assets. C. A heavy multi-decade discounted cash flow model driven by individual partner relationships. D. No valuation method can apply to a service firm. Take a second. Which answer would you pick? The correct answer is A, a price to sales or earnings-based approach. A is correct because an asset-light, relationship-driven service firm carries little in the way of hard assets. So its value tracks revenue or earnings rather than property. A price to sales or earnings-based multiple benchmarked against comparable practice sales is the practical fit. B is wrong because asset-based valuation suits firms whose worth is mostly tangible property. A consulting firm with almost no fixed assets is a poor match for it. C is wrong because a sprawling, multi-decade discounted cash flow model resting on a handful of individual partner relationships is fragile and ill-suited to this kind of business. D is wrong because service firms can certainly be valued. The point is choosing a revenue-based or earnings-based approach rather than an asset-based one. Picking the wrong valuation method doesn't just give you an imprecise answer, it gives you a meaningless one. Nowhere is this clearer than with an asset-light consulting firm, a dozen partners, almost no fixed assets, and a loyal client base. An asset-based valuation would price this firm near zero because it owns almost nothing, but its real worth lives in client relationships, reputation, and the steady earnings those relationships generate, none of which shows up on a balance sheet. The deeper principle, the valuation family must match where the value actually comes from. Tangible assets call for asset-based methods. Steady revenue or earnings call for a multiple and long. Projectable cash flows call for discounted cash flow. This is why asset-light, relationship-driven firms are the textbook case for revenue or earnings multiples. The multiple captures the flow of business, not the furniture, by benchmarking against how comparable firms have actually sold. The real skill in valuation isn't the calculation. It's choosing the right family of method before you calculate anything at all. Question 43. A small landholding company owns 20 undeveloped 1-acre parcels, carries them on its books at their decade-old purchase cost, has no brand value, and does little else. Comparable parcels nearby have recently sold for far more than that historical cost. Which valuation approach fits this business best? Your options are A. Earnings-based valuation using a price-to-earnings multiple. B. Cash flow-based valuation from a long projectable cash stream. C. Asset-based valuation using the fair value of the land. D. Price-to-sales valuation based on annual revenue. Before I reveal it, which one do you think is right? The correct answer is C. Asset-based valuation using the fair value of the land. C is correct because a firm whose worth is essentially the fair value of the property it owns, with no brand or meaningful operations, is the classic case for asset-based valuation. Valuing the 20 parcels at their current comparable market value captures what the business is really worth. A is wrong because an earnings multiple needs stable, meaningful earnings and comparable operating peers, which a passive landholder does not have. B is wrong because cash flow-based valuation suits firms with a clear, projectable stream of cash flows, but undeveloped land generates no such operating stream. D is wrong because a price to sales multiple fits revenue-generating service firms, whereas this company's value lies in its land, not in sales. Some companies don't earn much of anything. They just hold valuable property. For a firm like that, the right valuation tool isn't a multiple or a cash flow model, it's asset-based valuation. The logic is simple. Figure out what the assets are truly worth today, subtract what the company owes, and the remainder is the business's value. It skips forecasts and multiples entirely, relying only on current asset values. Picture 20 acres of undeveloped land, still on the books at what it cost a decade ago, while nearby comparable parcels now sell for far more. Fair value corrects that stale number and reveals what the landholding company is really worth. An earnings multiple needs stable earnings and comparable peers. A cash flow model needs a projectable stream of operating cash. A revenue multiple needs revenue. This company has none of those. It only owns land, so owner asset-based valuation fits. A service firm's worth lives in intangibles and earnings, so this method would understate it. But for the landholder, value lives in tangible property, and asset-based valuation captures it exactly. Recognizing where value truly resides is the real skill. Question 44. A company's shares trade at $60. Last year's actual earnings per share were 3 or 0, and next year's forecasted earnings per share are 4.1. What are the trailing and forward price to earnings ratios in that order? Your options are A, 3 and 20, B, 20 and 20, C, 15 and 15, D, 20 and 50. What's your answer? Commit to one before I continue. The correct answer is D, 20 and 15. D is correct because trailing PE uses last year's actual earnings. So it is $60 divided by 3 years, which equals 20. Forward PE uses forecasted earnings, so it is $60 divided by 4 years wide, which equals 15. The trailing figure is higher because it divides by the smaller past earnings number. A is wrong because this reverses the two results. Dividing the $60 price by the 3 trailing earnings gives 20, not 15 for the trailing figure. B is wrong because a forward PE of 20 would require forecasted earnings of $3 raise, but the forecast is $4, which yields 15. C is wrong because a trailing PE of 15 would require last year's earnings to be $4, but the actual figure was 3.0, which yields 20. The price to earnings ratio comes in two versions that share the same price but divide by different earnings figures, and mixing them up is one of the most common slips in valuation. Both versions divide a company's share price by its earnings per share. The trailing version uses last year's actual earnings, while the forward version uses next year's forecasted earnings. Take a concrete case. Shares trade at $60. Last year's earnings were $3, and next year's forecast is $4. The trailing PE is 60 divided by 3, giving 20. The forward PE is 60 divided by 4, giving 15. Because forecasted earnings were larger than last year's, dividing by the bigger number produced the smaller multiple. The safeguard is simple. Trailing looks backward to reported earnings. Forward looks ahead to projected earnings, and swapping the two reverses your conclusion. Neither multiple is the PE ratio in some absolute sense. Each depends on which earnings figure it uses. Get the denominators right, and the two multiples work together. Get them crossed, and every conclusion points the wrong way. Question 45. An analyst argues that in theory, forward price to earnings is more conceptually aligned with valuation logic than trailing price to earnings, even though it depends on a forecast. Which reasoning best supports that view? Your options are A. Forward PE is always a smaller number than trailing PE. B. A share price is thought to reflect the present value of expected future earnings, so a multiple based on forecasted earnings matches that logic more closely. C. Forward PE removes the need to check accounting quality. D. Trailing PE cannot legally be disclosed by public companies. Pick one. Trust your gut. Here's your chance to test yourself. The correct answer is B. A share price is thought to reflect the present value of expected future earnings, so a multiple based on forecasted earnings matches that logic more closely. B is correct because a share price is understood as the present value of future earnings, so a multiple built on forecasted, forward-looking earnings aligns more naturally with what price is supposed to represent. That conceptual match is why forward PE is favored in theory, provided the forecast behind it is sound. A is wrong because forward PE is not always smaller. It is larger whenever forecasted earnings fall below last year's. Its theoretical appeal has nothing to do with being a smaller number. C is wrong because forward PE actually depends heavily on accounting quality, since it rests on a forecast that must be built from trustworthy figures. D is wrong because trailing PE is routinely disclosed and discussed. There is no legal barrier to reporting it. Why is a forward price to earnings ratio considered more theoretically sound than a trailing one, even though it relies on a forecast? The answer comes down to what a share price actually represents. A share price is the present value of the earnings a company will produce in the future, not what it already produced. Last year's earnings have already happened and can't affect the value of owning the stock going forward. So a multiple built on future earnings matches what price is actually supposed to represent. Some tempting explanations are simply wrong. The forward multiple isn't preferred because it's always a smaller number, because it removes the need to check accounting quality, or because trailing multiples are somehow improper to disclose. The genuine reason is alignment with future-oriented price, nothing else. Trailing PE divides price by last year's realized earnings, while forward PE divides the same price by next year's forecasted earnings. Since price is meant to reflect future earnings, the forward multiple honors that logic more directly than the trailing one does. But theoretical superiority does not survive a bad forecast. Prefer the forward multiple in principle for its alignment with what price means, and trust any specific forward multiple only to the degree its forecast has been validated. Question 46. In a certain market, security prices quickly and fully reflect all publicly available information, including the contents of financial statements, but not private inside information. Which form of market efficiency does this describe? Your options are A. Weak form efficiency, B. Strong form efficiency, C. Semi-strong form efficiency, D. No efficiency at all. Which would you go with? Lock it in before the reveal. The correct answer is C. Semi-strong form efficiency. C is correct because semi-strong form efficiency is defined by prices reflecting all publicly available information, including financial statements but not private information. Large, widely followed companies tend to behave close to this form, absorbing new public disclosures quickly. A is wrong because weak form efficiency covers only past price and volume data, a narrower information set than all public information. B is wrong because strong form efficiency would require prices to reflect private inside information as well, which the scenario explicitly excludes. D is wrong because prices here do incorporate public information quickly and fully, which is a clear description of efficiency rather than its absence. Market efficiency describes how quickly a market folds new information into prices. Finance theory sorts this into three forms, and what separates them isn't how efficient they are, but exactly which set of information prices are said to already reflect. Weak form efficiency claims prices reflect only past price and volume history, so chart patterns alone can't beat the market. Semi-strong widens that to all public information, including financial statements and news. Strong form goes furthest, claiming even private inside information is already priced in. The key insight is that these three forms are nested, not separate categories. Semi-strong includes everything weak form covers plus public disclosures, and strong form includes everything semi-strong covers plus private information on top. When a scenario describes prices reflecting a specific category of information, that category tells you the form. Past trading data alone signals weak form. Public information, including financial statements, signals semi-strong form, and public plus private information signals strong form, though that extreme is almost never observed in real markets. Large, widely followed markets tend to behave close to semi-strong efficient, quickly absorbing public disclosures. That means analyzing public data alone is unlikely to consistently beat the market, which is exactly why understanding these three forms matters for the rest of your financial statement analysis. Question 47. Research consistently finds a statistically significant relationship between a company's unexpected earnings and its stock returns around the announcement date. Which interpretation of this finding is most accurate? Your options are: A. Earnings surprises are one real and significant driver of stock returns, but they explain only part of total price movement. B. Earnings surprises fully and completely explain all movement in a stock's price. C. The relationship is a coincidence with no research support behind it. D. Only negative earnings surprises move prices, while positive ones never do. Don't overthink it. Which one feels right? The correct answer is A. Earnings surprises are one real and significant driver of stock returns, but they explain only part of total price movement. A is correct because the earnings return association is real and statistically significant, yet it accounts for only part of a stock's price movement. Much of what moves a share price comes from other information entirely, such as changing industry conditions, strategic shifts, or revised growth expectations. B is wrong because claiming earnings surprises explain all price movement is a classic overreach. The relationship is partial, not complete. C is wrong because the relationship is one of the most well-established findings connecting accounting numbers to markets, not a coincidence. D is wrong because prices move in the direction of the surprise for both positive and negative results, not only for losses. Unexpected earnings and stock returns really do move together. When a company beats or misses expectations, its stock tends to move in the same direction, especially right around the announcement. That relationship is real and well documented, but the trap is stretching it too far. This fits semi-strong market efficiency. Financial statements are public information, so a market that absorbs public news quickly should reprice a stock the moment genuinely new earnings information arrives. A positive surprise lifts the price, a negative surprise drags it down. Earnings surprises are a real significant driver of returns, but not the only one. Shifting industry conditions, strategic changes, revised growth expectations, and a changed valuation, multiple, all move prices independently of the latest earnings number. Picture total price movement as one circle. The earnings surprise fills only part of it, while everything else, unrelated to that single release, fills the rest. That's the correct picture, not one where earnings fill the whole circle. The disciplined view credits earnings surprises with real measurable influence, while remembering that industry shifts, strategy, growth expectations, and valuation multiples all share the work of setting prices. Question 48. A skeptic argues that if markets are semi-strong efficient, no one should bother with financial statement analysis at all, which is the strongest counter-argument drawn from the framework. Your options are: A. Markets are never efficient in any form, so the skeptic is simply mistaken. B. Financial statements are private information, so efficiency does not apply to them. C. Efficient markets guarantee every stock is perfectly priced at all times, so analysis is harmless. D. Analysis is what keeps markets efficient. Mispricing can still occur in less followed securities, and many real-world uses of the framework do not depend on beating the market at all. Got a guess? Lock it in. The correct answer is D. Analysis is what keeps markets efficient. Mispricing can still occur in less followed securities, and many real-world uses of the framework do not depend on beating the market at all. D is correct because widespread analysis is what makes prices efficient in the first place. Less followed or opaque securities are exactly where careful analysis can still find gaps. and many users of the framework, such as lending, acquisitions, and governance, have nothing to do with beating the stock market. Together, these rebut the skeptic directly. A is wrong because the framework does not claim markets are never efficient. It accepts that large markets are often close to semi-strong, efficient, and argues analysis still matters anyway. B is wrong because financial statements are public information, so this premise is simply false. C is wrong because efficiency does not guarantee flawless pricing at all times, and this reasoning does not actually explain why analysis remains valuable. If markets already reflect all public information, why bother analyzing financial statements at all? It's a fair challenge, but it rests on an assumption that's far too narrow. First, prices only become efficient because analysts constantly study statements and trade on them. Stop analyzing, and efficiency vanishes. Second, real markets aren't uniformly efficient, small, thinly followed, or opaque companies are exactly where value and price diverge. Third, decisions like lending, acquisitions, and executive pay never depended on beating the stock market to begin with. Efficiency is strongest where disclosures are clear and coverage is heavy. But in the corners of the market, smaller firms, opaque reporting, low accounting quality, that gap between price and value is exactly where careful analysis pays off. A bank deciding on a loan, a buyer pricing an acquisition, a board setting pay, a manager benchmarking rivals. None of these care whether public equity markets are efficient. They all still need the same independent judgment of performance, risk, and value. Market efficiency and financial statement analysis are compatible, not opposed. The framework earns its keep by sustaining efficiency, finding the gaps it misses, and serving countless decisions that were never about beating the stock market. Question 49. An analyst is sorting sources of financial information into primary sources filed by the company itself and secondary sources produced by outside parties. Which of the following is a secondary source? Your options are A. The company's annual report on Form 10-K. B. An independent analyst research report on the company. C. The company's quarterly report on Form 10-Q. D. The company's own earnings press release. Which one is it? Pause the video if you need more time. The correct answer is B. An independent analyst research report on the company. B is correct because a secondary source is produced by an outside party rather than the company itself. An independent analyst research report interprets the company's disclosures from the outside, which makes it secondary, unlike the firm's own filings and releases. A is wrong because the Form 10-K is the company's own annual filing, a primary source produced directly by the firm. C is wrong because the Form 10-Q is the company's own quarterly filing with the securities regulator, also a primary source. D is wrong because an earnings press release is issued by the company itself, so it is a primary source rather than a secondary one. Every analysis rests on information, and that information splits into two kinds based on who produced it: primary sources and secondary sources. Getting this sorting right matters because the two carry different authority and are used differently. Primary sources are the company's own filings and communications. The annual report, or Form 10-K, is the cornerstone, updated through the year by the Form 10-Q, with current events disclosed on Form 8-K, alongside proxy statements and earnings releases. Each comes directly from the company itself. Secondary sources are produced by parties other than the company: analyst research reports, credit rating agency opinions, industry publications, and news coverage. These add interpretation and outside judgment, but they're one step removed, filtered through someone else's perspective rather than first-hand. A quick test settles most cases. Ask who produced the document. If the company produced it, it's primary. If an outside party produced it, it's secondary. Origin, not format or reliability, is the dividing line. Everything the analysis builds afterward depends on disclosures, most of which are primary. Lean on primary filings for the underlying facts, and on secondary reports for perspective, but never confuse an outsider's read for the company's own record. Question 50. A company reports a one-time $10 million gain from selling an unused warehouse, which lifts this year's net income. When forecasting next year's earnings, how should an analyst treat that gain? Your options are: A. Add the same $10 million gain again next year since it happened once already. B. Increase the forecast by more than $10 million to stay conservative. C. Ignore this year's earnings entirely because they contain a gain. D. Strip out the $10 million gain as a transitory item and forecast from the persistent component of earnings. Take a second. Which answer would you pick? The correct answer is D. Strip out the $10 million gain as a transitory item and forecast from the persistent component of earnings. D is correct because A. One-time gain from selling a warehouse is transitory, not expected to recur, so it must be removed before projecting future earnings. Forecasting from the persistent component keeps the projection and any valuation built on it from being overstated. A is wrong because repeating a one-time gain assumes it recurs, which is exactly the error the persistent versus transitory distinction warns against. B is wrong because inflating the forecast by even more than the gain compounds the mistake rather than correcting it. Conservatism means removing the transitory item, not adding to it. C is wrong because the persistent portion of this year's earnings remains useful for forecasting. The fix is to strip out only the transitory gain, not to discard the whole year. A company sells a warehouse and books a one-time gain that boosts this year's net income. The question is what to do with that gain when forecasting next year, and the answer separates careful analysts from careless ones. Persistent earnings reflect the ongoing, repeatable operation of the business. The sales and margins likely to show up again next year. Transitory earnings are one-time events, like a gain on selling a building, a lawsuit settlement, or income from a discontinued operation, and they are not expected to recur. Picture a reported earnings figure that includes a $10 million gain from selling a warehouse. The correct procedure splits that figure into two pieces: the persistent earnings that carry forward into the forecast, and the transitory gain that gets set aside because it will not happen again. If an analyst forecasts from the unadjusted figure, the projection silently assumes the company will sell a warehouse for the same gain every year, which is absurd. That error doesn't just distort next year's earnings estimate, it inflates every year of the forecast, and ultimately overstates the entire valuation built on top of it. Not all earnings are created equal. Persistent earnings are the signal worth projecting forward, while transitory earnings are noise that must be removed first, keeping both the forecast and the valuation honest. With that, we've worked through everything in Domain 1, the 6-step framework. To keep practicing everything we just covered, visit our website using the link in the description below. There you'll find hundreds of free practice questions plus complete study guides all ready and waiting for you. It's a great next step to reinforce what you've learned today, sharpen your skills, and build real confidence before exam day finally arrives. Subscribe to stay with us for the next video, and good luck on your financial statement analysis exam.